Hello Deep Value community, thank you for tuning in. In today's video, we're going to talk about 6 things that matter most when picking out an investment. If you're new to the channel, please subscribe now so you can get my next video installment. Let's get started. Number 1. Balance sheet, balance sheet, balance sheet. If you don't understand the company's balance sheet, I've got videos on that, but this is the most important aspect of investing. If you don't understand the company's well-being, you're going to be screwed up. So you need to pick out an investment that is stable. You need to pick out an investment that has enough liquid assets to be able to overcome whatever's coming its way in the next 12 months. So for this, the easiest thing to do is go to sec.gov, look at the latest balance sheet. That can either be on the 10K, on the 10Q, and just figure out straight away, does the company have actual cash? And is it able to have enough current assets that are higher than its current liabilities over the next 12 months? So, just as a quick reminder, the current assets are assets that are very much liquid, the company can get access to in the next 12 months. These can be investments that are very much short-term nature, or this can be just like liquid cash, or this can be inventory, something that is very much liquid, and the current liabilities similarly are things that are due in the next 12 months. This could be short-term debt, so you just want to make sure that the current assets are more than the current liabilities, okay? Within the balance sheet, it's also quite important to understand how much debt does the company have. Now, you don't want to be invested in a company that has just too much debt, because that's going to cripple your upside. The company is going to be strangled. So you want to be able to, a company that has a strong balance sheet. I've got videos on balance sheets, so this is something that is very, very important. This is my number 1. The next thing that matters is describe to me what the company does in 10 seconds. Tell me, company is called Apple. Apple sells iPhones. iPhones is trying to get you into the ecosystem. It's going to try and sell you services. Done. It's this high-level type of analysis and description of the company that's going to make you understand the company. So if you can't describe the company in 10 seconds, you have no position being invested in that company. No matter who tells you that that company is going to work out favorably over the next 12 months, if you don't understand what the company does, when the company falls 50%, and trust me, it will fall 50%, you won't know. Even Berkshire Hathaway, 3 times over its course, has fallen 50%. Most companies will at some point fall 50%. In fact, the argument could be made that many companies on average from top to bottom over a 52-week period fall 50%. So you got to be able to understand what your company does very succinctly. Number 3 on the list, is the company stable? By stable, I mean, is the company's revenues going up very small increments over time, or is it going to go up a lot one year and down another year, and it's so cyclical that it's difficult to predict what the company is going to do over the next 3-5 years. If you haven't got that grasp of what the company is going to do over the next 3 or 5 years, it's maybe not better not to get involved in that type of company. You need to understand, is the company going to be more relevant? Is the company going to be stronger in 5 years' time, or is the company going to be obsolete? So, if the company is going to be obsolete, don't get involved with that. There are people that specialize in that kind of things. Don't get involved with that. Unless you really, 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 really feel it's undervalued, it's going to be a tricky game. You're most likely just speculating, and it's a tough game. And don't even consider, for example, this company is trading for less than liquidation value. Unless you know for absolute certainty that that company is going to be liquidated, i.e. it's going to go bankrupt, don't get involved, because playing for bankruptcy is a very difficult game, okay? Most likely the equity is going to be wiped clean. So try to see, is the company's margins relatively stable? Are the company's revenues growing over time? Number 4 on the list, does the company actually make free cash flow? It's kind of difficult being invested in a company that doesn't make free cash flow. Now, during this period, there are many companies that have no path to profitability. Think of your companies like Uber and stuff like that. Actually, they just vehicles that are overvalued. Now, you want to try and pick out businesses that actually make earnings, because in reality, your likelihood of picking out the next Netflix is very, very small. Okay, you can look back in hindsight and say, oh, Netflix was a great investment, but to be able to do that today and pick out the next Netflix, the next Amazon, is a very, very tricky business. The way that Buffett made his money over time is that picking out businesses that were very stable, durable businesses, entrenched businesses, businesses with strong competitive advantages, or as Buffett calls them, moats. So these businesses have like monopolies or duopolies. They're so entrenched and it's quite predictable how they're going to do over the next 3-5 years. So try to pick out businesses that actually make earnings and try and see that these earnings are growing over time. That's really what you want to be trying to play at as a value investor. Number 5 on the list is valuation. If you don't understand the businesses, if you can't tell if it's undervalued or overvalued, you shouldn't really be invested. Sometimes it's a bit tricky, or sometimes it's so exciting. Like, for example, company XYZ or Tesla, it's like, that company is like so exciting. But is it undervalued or is it overvalued? It's difficult to know, It is, you can make the argument either way. So you don't want to be investing in a business that you can make an argument kind of either way. You want it to be so clear. Okay, yeah, this is really, really undervalued because of XYZ. I've got a video on different multiples that are important. I prefer to look at the price to free cash flow. Now, you want to pay as little as possible for the company. I don't like to pay more than, let's say, 6 or 7 times free cash flow. I have made exceptions in certain cases where I believe that the business has very long tailwind ahead, but predicting growth is quite difficult. It's very, very difficult to do, to try and understand the company that is growing, let's say, 30% a year. It can grow at 30% a year for about 3-5 years, but trying to understand those businesses is really tricky. You want to try and go for businesses that are really kind of boring, always. Remember Buffett, right? So you want to try to go for businesses that are growing predictably, not sexy businesses. You want to go for businesses that have been around for a while, have been through certain economic cycles, that are able to grow their earning power over time. So try to pick up businesses that are not too expensive. More often than not, businesses are fairly valued, so those are not good investments either. The market is mostly right. As Buffett says, the difference between mostly right and always right is the difference between night and day. So try to pick up businesses that are undervalued. If the business is kind of like close to fair value, just let it pass. There is no rush. There's going to be plenty of opportunities coming over the next 2 months or 3 months. If you're going to be investing in a business for, let's say, 3 or 4 years, don't rush it. Number 6 on the list is the last step that I believe is critical. So look at the company's earnings calls. The way I do it is I go for the most recent earnings call and I go backwards in time. I start with the earnings call for the latest quarter and I go back 4 quarters and I start again from that point and go forward. Now, here's a little trick that you can do. If you're kind of new to the game and you say, okay, I don't really have that much time, just read the CEO's descriptions and the CFO and go backwards over 4 quarters, and then from that point look for the analyst, what the analyst is saying, and go forward to the most recent quarter. That is a bit of reading, I admit, and many people are kind of put off. I don't want to get too involved. I kind of get a feel for the business. Now, when you buy an investment, it's like buying your home. You have to do the due diligence. You're going to be stuck with that business most likely for about 3 or 4 years. The likelihood of you being able to make a profit in a business in less than a year is just speculation. Businesses take time to grow. Businesses take time to turn around. So you as an investor are only going to get the valuation come up over time if the business's intrinsic power comes up over time. If the earning power doesn't increase, then your investment is just going to go up or down, but it's difficult to know. Your investment will increase as the business's earnings power increases over time. So to summarize, the 6 points that are important when investing. Number 1 is balance sheet, balance sheet, balance sheet. Number 2 is whether you can describe the company succinctly. Number 3 is whether the company is stable. Is its revenue going up over time, or is the company very volatile? Is the company's earnings and earning power quite stable? Will be number 4. Number 5 is to think about valuations. Valuations very important. You can have the best business in the world. At the wrong valuation, it's not going to work out favorable for you. And finally, number 6, you have to read those transcripts. Start at the latest transcript, go back 4 quarters, and then come back forward while reading the analyst comments as well. Try to get a feel for what the analyst is saying. The analysts follow that same company for about 10 years. They know the company better than anyone else. More often than not, their questions are quite immaterial and they're very short-term oriented, but certain analysts will ask about capital deployment, whether the company is going to be doing a lot of merger and acquisition, whether the company is going to increase its dividends, whether they're going to do share repurchases, whether they're just going to pay down debt. So those things are very, very important. I hope you found this video useful. Please subscribe so you can get my next video installment. See you soon.